Okay, so let's do a leverage ratios example here, going back to Continental versus Love. Um, so we've got down here some of our financial leverage ratios and the one operating leverage ratio that is useful and easy to get as an outsider. Okay. So let's see what we got here. Unless otherwise stated, consider uh, for the past year on average, which firm has the higher level of debt financing? Okay, so let's check this out. Higher level of debt financing. Okay, well, that's clearly going to be financial leverage. And I would argue that there are two perfectly fine ways to answer a question like that. Either debt to assets, which is total debt over total assets, or we could have, oops, we have a little bit of a problem here. So we'll do that. Or our debt to cap ratio, which is my favorite. Total debt over quantity, total debt plus equity. The numbers will be different, but they should both be pointing in the same direction. And if you're asked an open-ended question like that, you should be able to answer it with whichever of those two ratios you prefer. All right, so who's got the higher level of debt financing? Um, Starting with debt to assets ratio, we see Continental 40% of its total assets were financed with debt, and only 11% of Southwest were. So clearly it's Continental. And if we're looking at debt to cap ratio, okay, so the total debt of Continental is about 77% of its total capitalization, and only for Love, that ratio of total debt to total capitalization is only about 23%. So it's clearly this clearly Cal. So let's go ahead and put that in. Clearly Cal from the debt to assets or debt uh, to capital, either one. Which firm has the higher operating leverage? Okay, well, that's going to clearly be from our SDI to COGS ratio. And that's down here. And as we know with Continental, always on the first line, Love always on the second. Um, and so what's in the numerator here? Our fixed costs are in the numerator, our variable costs are in the denominator. So bigger is going to be higher. In this case, a bigger number is going to be higher fixed to variable, and it looks like Southwest has higher fixed to variable costs. Okay, and that'll be the same, of course, as operating leverage. And so we're going to say Love from SDI to C to COGS. And again, what's SDI stand for? SDA, depreciation, interest. All three of those don't have too much to do with variable costs. Okay, based on our answers to 1 and 2 above and sales trends for both companies for the past 2 years, which firm would you rather lend to and why? So let's go back and look at the uh, sales trends. Best way, I think, to look at sales trends is to look at the sales growth for each company. And we're looking quarter by quarter, but year on year, as we know. And the sales growth for each company is healthy and uniformly monotonically increasing. So that's good. Okay, so one one company clearly has much more financial leverage risk than the other. Okay, this is, once again, maybe you guys don't have quite enough experience to suss this out yourself, but 78% compared to 23%, that's a very, very big difference in debt to cap, and 78% is in pretty risky territory. The operating leverage of both firms is low enough that I'm not going to worry about that to answer this question. So what do we got here? Which one would I rather loan to? Well, clearly Continental has more risk of bankruptcy if things go wrong, but things will be better in good times. And both of them have good sales trends. So let's think about this a little. I'm gonna say here that this is what makes a market. There are two fully acceptable, let's see, even say great answers we could put here. A would be love, because it has less risk of bankruptcy. And that would be something that the conservatives among us would want to do. And B, on the other hand, we could say just the opposite, and this is what makes financial markets so interesting, is that there's all sorts of different views out there. So the rationale for Cal would be something like this. Riskier firm would imply we could demand a higher interest rate. And actually you see that in the market. When we get to our next phase, liquidity, we're going to see that the interest rate on Continental's debt is higher than the interest rate on Love's debt. So either of those answers would be great. And that's one of the great things about finance, is as long as you can argue your position rationally, you can have a view, wide variety of views. I am going to, in the interest of time, I am going to skip these questions. They are covered in the text if you want to look at them in the text. They're not essential for understanding what's going on and preparing for midterm 2. So I'm gonna skip them. Okay, so let's move on to liquidity. And that I'm going to make another quick pause here, and then we will finish out the chapter with liquidity when we return.